today we've just titled it a mid-year update and hitting the three things that everyone is talking about, which is the inflation at hand, recession, and the Fed and or central banks across the world. So it has not been an easy start to the year. In fact, it's been the worst start to a year since 1932 for a 60-40 portfolio. It is rare that you have both stocks and bonds down double digits in a single half year, but yet it has occurred here. So the big premise here is, is diversification dead? Should we be doing anything different? What is the outlook here? And that's what we're going to be covering in today's webinar. So there was no place to hide this year. This is a really busy chart, but this is my best way to show you that it was not a great place to be invested in pretty much anything. So what this is looking at is a multitude of asset classes, looking from the S&P to small cap to international to emerging markets to bonds to corporate bonds to REITs. And looking at all these asset classes, and the top line, the top graph is showing the number of those asset classes, the classes that did greater than a -7% for the year. So why -7%? Well, that's what our research firm put out there. So it just shows you, kind of relative performance to the past. And this first half of the year had 0 of those, greater than -7% for the year. Going all the way back to 1982, that's never happened before. On the bottom, it kind of gives you what the range of returns was. And you can see the blue line is the maximum return, the diamond is the median, and the red is the minimum. And those are all real bad, right? So they're all within the, close from -7 down to, down to -17% or so from an asset class. So it was just a very bad start to the year. And what I'm going to cover here is kind of why that has occurred and what we need to look at as we move forward here. The interesting part about this is you would look at this and think that we are in a dire economic situation, but that isn't what's happening here. What you're looking at on the top is the world index, which is the global stock market. But the red line is looking at JP Morgan's global manufacturing PMI. What is that? That's just called the Purchasing Managers Index. In our opinion, as well as the opinion of Ned Davis, this is one of the best ways to look at the global economy. When a PMI is above 50, that means we're in expansion. When it's below 50, it means we're in some level of contraction. And Ned Davis has sort of a line in the sand saying around a 48 number is where we really got to start getting worried. And you can see where we are today is that not only are we above that dotted line that could be where we see the global economy really contracting, we're actually in expansion mode across the world, despite everything that's going on: central banks tightening, high inflation, a war, political uncertainty. We are still, the global economy is, as of recently, still growing. The risk here is that the central banks around the world have been going into a phase where they are raising interest rates, okay? So the chart here is a great one I reference all the time. It's what percentage of the central banks around the world whose last rate change was a cut in rates. And now we're at a very low level. In fact, we're the lowest level since the financial crisis. Well, why is that? It's because in central banks around the world, and there's been really very few exceptions to this, are all fighting inflation. And in order to do that, they are raising interest rates to reduce demand and change that moving forward. Now, why is there inflation? Well, it's because of the massive amount of stimulus. You can look here to see how many central banks had cuts just not that long ago, and it was over 90% had cuts. So everyone was fighting that COVID stay-at-home economic deterioration by pumping massive amounts of money into the economy. And they did not perhaps move quick enough to combat that. And now they're paying sort of emergency triage on the inflation situation. And as I mentioned, it is all about inflation. That is across the headlines. You all know that too. No matter what situation you are, whether even if you're driving an electric car, if you've been taking any kind of travel recently, you've been going to the store, everything has moved up in price. And typically, and unfortunately, a lot of those prices, once they move up, they do not come down so fast. So we are seeing the highest level of inflation since the 80s at roughly 9%. Now, why is that happening? Lots of reasons. Too much money in the economy, right? So there's too much money that was sloshing around out there. Supply chain issues were out there, right? So the war causing energy prices and commodity prices across the board to move up. So and then we've seen services, right? There was not enough people at certain types of services to satisfy the demand when everyone could finally go out and do things again, like travel and eat at restaurants. So it's this perfect combination that was already happening, and then you had the war on top of it. So just push this over the edge, along with China's stay-at-home COVID policy, or the zero COVID policy, where they said, hey, we're not going to do anything. So it shut down massive amounts of their economy, which really affected the global supply chain. Well, there are some good and bad news as we look through the inflation numbers. First off, supply chain issues have peaked in December of last year, which is this orange line. It's called the Supply Chain Pressure Index. Yes, there is an index for everything, and that is coming down. So what Ned Davis has done here, so you can see that coming down. What we've done is we've correlated that to the Consumer Price Index. And what they're doing is they're advancing the supply chain pressure ahead 6 months to show you what might happen to CPI. Well, if this chart holds true, there's actually a pretty strong correlation between these two things. And we should see CPI coming down, at least as it relates to this particular problem. And that's assuming no other disruptions occur moving forward. Another piece of good news is that commodity prices have come down. So these really spiked up, especially oil, natural gas, etc., and food, because Ukraine and Russia control a lot of the grain market. These all spiked up very quickly. Now, they've come down actually very quickly as well. So oil, they're still elevated. As you go to the pump, it's still expensive, although it's less than it was before. And by the way, gas stations don't seem to cut prices as quickly as they raise them. But nonetheless, these have been coming down. So this is another good sign that inflation, as we look at it from these couple indicators, look pretty positive, like it might have peaked. Unfortunately, on the same chart here, you can see this black dotted line, which is the CPI services index, less energy services here, to kind of remove that factor of the energy sector. This is where there's a problem. So this is where we're seeing things like, hey, the food prices, this is where you're seeing, I'm sorry, not food prices, you're seeing travel prices, restaurant prices. Everything that you can think of as a service is going up in value in terms of price. Why is that? It all started because there just wasn't enough people to do the job originally, also because of some COVID issues, but it's still been sticky. So airlines typically raise prices, and effectively they only have so many planes to fill. So when they get to a certain level, they just keep rising prices. There's only so many seats left on the plane. So eventually people usually will stop booking flights, and there becomes a balance in supply demand. I don't know if you've been to the airport recently. That doesn't appear to be ebbing, even though flights are extremely expensive. Hotel rooms are extremely expensive, but people are still traveling. So the services continues to move up here. And services is actually a pretty large portion of our economy. And perhaps what I think is the stickiest place of inflation here is the CPI for rent. So a large component of what we consider CPI is what they call owner's equivalent rent, or what it costs to rent your primary residence. That is this orange dotted line. And you can see this moves up. However, it typically lags the housing market price increase. So this is where this has moved up, and it's gone up quite a bit in a very short amount of time. Whoops, sorry. And then the housing number is on top of that blue line. Although we do and have been talking about the fact that housing market prices, we think, are elevated. We think that they are coming down. We think that they moved up too quick. It doesn't necessarily mean that they come down quickly, okay? We think they are peaking, and we think, but this consumer price index for rent usually lags. So this, we think, is going to continue to move up, even if we start to see the housing market roll over. Eventually, rents will be able to stabilize. Whether they come down or not is a whole different thing. But remember, inflation, we're caring about the price from this time moving forward, not what it was last year. If rents have already gone up 10 or 15%, it's the CPI number that the Fed's going to watch is the future inflation from where we are today. The best piece of news that I can provide on the inflation front today is the inflation expectations. This blue line is looking at the 5-year inflation expectations, and it reached a peak of around 3.6%. That's saying we're going to have inflation at 3.6% on average for the next 5 years. That is way ahead of the Fed's 2 to 2.5%. So this has come down quite a bit recently. And I think this is pretty correlated with the market. This has come down. The markets had put in a bit of a bottom here and started to rise. And I'll talk a little bit about this in a minute. This is going to be the key measure to watch. That there's some version of this that the Fed is actually watching. So the Fed has talked about front-loading rate hikes to try to bring this in check, and that appears to be working. This is still elevated, but this is somewhat of good news moving forward. Now, complicated chart. I show this. I've been showing this really since this whole thing started, and also back in the COVID days as well. All these are market expectations. So here, just to remind everyone, here at BWM, we look at objective indicators. I'm not going to sit here and try to predict what the Fed's going to do, when they're going to raise, when they're not. We'll leave that to all the big institutions out there to get that wrong. What we're going to look at is we're going to say, based on where the market sits today, what does the market think the Fed's going to do? And more importantly than what it's going to do, like what they think it's going to do now, it's the change in that expectation. And if we look at this orange line, this was what the Fed was expected to do over the next 12 months. And obviously it's running. It reached a high of hiking rates 2.5%. And you know what? When they hiked interest rates by 75 basis points, this would theoretically come down. It didn't come down that much, which means that because at the same time they did their last hike, it was even imagined they were going to hike faster and more than that. Well, look how far that has come down in such a short period of time. Why? Why is because the Fed was talking so tough. It's like the bully, right? The big bully, right, can talk so tough and maybe throws one big punch, which is what they did with a 75 basis point hike. But then it gets a lot of reaction from that. And I think that's what happened. Mortgage rates went through the roof, right? The markets fell down. Housing markets went from being a seller's market to a buyer's market really quick. In my local neighborhood, we saw massive price cuts on real estate. Oil prices came down. So, and the Fed only made a couple of moves on their interest rate hikes. So the big tough talk on what the Fed did then brought these expectations way down. Why? Because people started talking about a recession. Now the Fed's going to cause a recession because they're going to hike rates so much. Well, that's not a guarantee that that's going to happen. So, but I know that that's the topic of the day, and we're going to talk a little bit about that. So it is impossible to predict a recession. Everyone's going to have an opinion. Everyone has an opinion that a recession is coming this year or next year. It might, and it might not. And to invest around that and predict what's going to happen, I'll show you later that that's even if you knew when it was going to come and you're selling out at the beginning of the recession and you're buying in at the end of the recession, that also isn't a good strategy. So it's very tricky to navigate this. What we want to do is just have an idea of when we want to be slightly less in equities or more in equities and or take advantage of this. So first off, everyone's talking about the yield curve being inverted. That's when longer term rates are less than short term rates. Well, it kind of depends on what long-term rates and what short-term rates you're looking at, right? Is it the 2-year rate versus the 10-year rate? That's inverted. Well, we like to look at the 6-month rate and the 10-year rate. Why? Because it's been 100% accurate, 100%. A lot of these other ones are at 80%, whatever, but this has been 100% accurate, which means the 6-month yield is sort of where the Fed is, right? So it's when the Fed pushes short-term rates above long-term rates, that's create a recession every single time. And look where we are today. We're still a percentage point away from that inversion. Now, if we follow what the Fed's supposed to do, and if rates stay the same on the 10-year treasury, it could invert. If, right? Predict. We're just saying right now, this is currently not flashing a recession signal. Let's see here. Next, okay. Economy, a couple ways to look at the economy. Ned Davis has a great economic timing model. Unfortunately, all these things can move pretty quick. And this thing went fairly quickly from strong growth to slow growth. Now, what caused this? Well, all kinds of indicators, looking at leading economic indicators, looking at a lot of the things that you're seeing on a daily basis here. But this is not in a recession, and this is definitely not in a moderate recession yet. But it is slowing, and this could be, but it's still growing. And the question is going to be, can we still continue to grow? Or if we don't, how deep would a recession potentially be? Because ultimately, how deep and long it is matters more than any other question that we can answer today. So right now, this is still showing slow growth, although it could improve or not. I have a feeling it could probably moderate a little bit more from where we are today. The question is, will it be a technical recession or not? Another thing to look at is what we call leading economic indicators. These are things that look at the future rather than the past. It doesn't matter that CPI rose 9% in the last print. That already happened. Leading economic indicators look like things like yield curves, like the stock market, like jobless claims, things that are very short-term in nature. And as these begin to deteriorate, that blue line at the top that tracks the, line at the bottom that tracks these things will decrease, right, in value. And you can see it's rolled over a little bit, right? You can see it on the far, this orange line. I think I'll highlight it right here. So this is rolled over. So it's not going up anymore, but it's not dropping significantly. We need to have it drop like by a fairly decent margin from where we are today, maybe back to the, where we were in 2020 before this would signal a down arrow above, which would be a recession. Okay, so this is one thing to look at. If economic indicators, the leading economic indicators begin to deteriorate, this is going to give us a signal into the future. Is it going to get bad? And how bad might it be? Because you can look at the financial crisis, how bad economic indicators got. You can look at 2000, how bad they got. And the COVID thing was very quick, right? Down and back up again, because there was so much stimulus thrown at it. So, Tyler, you had a question?
Yeah, we had a question come in. Curious, has the market factored in a recession? I have heard that it has already.
Let me get to that in a moment.
Okay.
I have it covered. So the other thing that I think makes this really unusual. So right now, technically, you could say the first quarter was negative. There's potential that this quarter is negative. And you could say, hey, wait, we could already be in a recession because the definition of a recession is 2 quarters of GDP declining. Well, that isn't actually correct. A recession has to be called by an agency out there. And one of the key factors of looking at a recession is employment. And employment is very strong. In fact, the unemployment rate is at 3.6% as of the end of last month. That is very, very low. That is close to or at full employment. You can see on the top chart here, that is that's about as low as it's gotten right before COVID. So we're good on unemployment or the employed. And on top of that, there's a lot of people, a lot of job openings out there. Now those have corrected a little bit, but even here at my firm, it is not easy to find people. So the job market remains really strong, which makes me believe that if we are in a recession, however you want to define it, if the job market remains strong, that means that the recession could be more mild than the market, dropping another 20% from here to factor in a very bad recession like we would have in the financial crisis, all things being equal. So to get to your point, Tyler, has the market factored in a recession? Well, the challenging thing about this is that it's really hard to know. What I want to look at here is you can look at this line that shows recession start date, right in the middle here. I'm using my mouse to highlight that. Recession start date. Look what happens to the market before the start of the recession. We're already down. We're already down like almost, about half of where it could be, maybe a third, the first third. And then by the time it's actually called, so picking the start date is not always great because you've missed out on, you're already down. And look at this. I mean, this is probably the more interesting piece here, is that 6 months later, which is 126 days from the start of a recession, the average the market has been down has been about 5.5%. And then a year later, it's about flat. So if you're waiting to call, if the recession starts and you call it correctly, you got about, on average, some years, better, some years worse, you got about 5%. on the downside, on average, when all these recessions have happened. So then you got to make the other call, like, when do you get back in? Well, let's wait till the recession is over and then we'll do it. Well, that doesn't work so well either, because by the time the recession is typically called out in the end, right, you've already missed out on the bottom. So so when does the recession end? That's when everything feels good. And that is by the time that the recession is ended, you have already sort of missed out on anything that you would have hoped to gain by calling the first part right. So it's a very difficult thing to maneuver. And I think it's like a fool's errand to try to worry about when the recession is, what you're going to do. It matters a lot if you're running a small business. Stock market's always going to look ahead. It's always going to look ahead. So you want to be cognizant of trying to find the point of when to invest at the bottom and take advantage of it. It's really hard to get it right and say, hey, there was a recession coming because XYZ last year, and then we got out, and now we can look to see when to get back in. Not always so easy. So trying to take advantage and find out when that bottom is pretty key. So right now, some of our rules here. So one of them are sentiment. So we got to the level, and it was unusual. It took a little while before the phone calls started coming in. People getting nervous. That happened right at the recent market low, just not too long ago, couple 2 weeks ago. So sentiment has been very pessimistic for most of this year, and we got to a very low point recently. And generally, when that happens, that's usually a good sign. It's like, okay, we're getting close to some sort of bottom at this point in time. So we're at this pretty bullish zone. So this is a contrarian index. Typically, when we're down at this low, the market has performed 25% per year. That's on a daily basis. So we're not going to get 25%, but on a daily return, it typically does well in this zone. So when we're dollar cost averaging for client investments and we're in the pessimistic zone, we're putting about twice as much as we would normally put to work than if we were in the neutral zone. So this is a positive sign. I already mentioned our 3 rules is beware the crowded extremes, don't fight the Fed, and don't fight the trend. So the Fed was brutal, right? They kind of came out packing a punch, and they affected the market very greatly when they surprised the market with that 75 basis point hike that time. And so ideally, if you had a crystal ball, you knew they were going to talk that tough and change their tone in such a short order. Yeah, you would have cut exposure at that point in time. We had already trimmed our exposure earlier in the year, fortunately, to remove that overweight weighting to equities. So we're currently sitting around that underweight that I'll talk about in a minute. So, but if you already missed it, I think the Fed will see how they play out going forward. If they start to get really aggressive, they start that line I showed you earlier starts coming back, then we got to rethink that. But for right now, sentiment's a positive, the Fed's a negative, and momentum is also a negative. So this is the crowded extremes, which is like, how is the market behaving? Is it performing well in the longer term basis? Well, you don't need a chart for me to tell you that isn't doing well. So we need momentum to turn around. The biggest question is, how close are we getting to that happening? Once again, kind of looking at averages here, a lot of squiggly lines. What are all these squiggly lines? This is the global stock market looking at a number of years where we had what's called a cyclical bear market. So a short term, like a bear market down 20% or more within these longer term bull markets that we think we're still in. So we still think we're in a longer term bull market that started at the financial crisis. We can debate that a different time. I could talk about that if people have questions on it. But cyclical bears, and if you look at sort of where historically that black line is kind of where it bottomed out. Why does this chart end? Well, because then from there it goes up. So it shows you about how many days it takes to get there and how deep it is. And the red line is where we were at the end of June when I put this together. So when I grab this chart. So we're somewhat close, right? In terms of where the average decline is. The question is, does it get significantly worse from here? Another one to look at, just to kind of get a flavor for, we've had a big decline, a 15% decline in the S&P on a quarterly basis. Hasn't happened that many times. You can see how many times it's happened on this chart. And after World War II, the next quarter change was about 87.5% positive with an average return of 6%. The next 2 quarter change, 100% of the time it was up with an average of 13%. So you can see 25% four quarters later. So not guaranteed it's going to happen. Before World War II, there were some cases that didn't do this, different economic environment, different central bank, et cetera. But nonetheless, this gives a little bit of value to maybe it's not the right time to sell here given sort of looking, if you're using history as a guide. And what are we waiting for? We're waiting for what's called a breadth thrust. Okay, a breadth thrust is when you have a massive amount of the market, whatever market you're measuring, move higher all at once. So breadth is like momentum. We like to say momentum is which way the wagon is going, and breadth is how many horses are pulling it. If you have 500 stocks in the S&P 500 moving forward at the same time, it's a lot better momentum. And why do we look at this? Because it has a very, very good track. There's different measures, so this isn't the end all. There's multiple charts that track breadth thrust, but this is an example that just has an extremely good track record. You can see I highlighted the whole thing, but over here, you see that it's happened a total of 53 times since 1947. So actually that's not that many times. It's a lot of arrows, but that's a lot. I mean, that's a long period of time. Of those 53 times, 52 have been up and one has been down 12 months later. So that's a pretty good track record. The median return is around 17% over 12 months. In the shorter term, we could try to guess what that's going to happen. I'm more looking at 12 months from here. Where do we think that we're going to be? And so, we'll see how that plays out. In fact, one of the measures of breadth thrust, I look at probably about 5 of them every day. One of them actually fired yesterday. So with the big move we had, we had 2 10-to-1 up days after a 10-to-1 down day. I can show the chart if people have an interest at the end, but nonetheless, one of them did fire. So it's things like that allowed us, we had enough support, and you can look at the numbers that happened here in 2020, like enough support where we actually were able to get significantly overweight stocks in coming out of COVID and take advantage of that rally. And that's how you add some value to the bottom line, is to be ready and take advantage of what has occurred to try to get it back quicker. Because investing in the volatility, as we all know, that's just part of investing, right? That's part of the deal. You can't avoid it. It's just going to happen. So it's how you act and react when it happens and what you do during that time frame that is going to make the most in terms of trying to add some tactical, what we call alpha, to the portfolio or value add. One thing I want to mention is bonds. So bonds has gotten clobbered this year. We are very closely looking to actually, we've have a fair amount. We have cash in the portfolio. We have short-term bonds. We have longer-term bonds. We are very close to making changes potentially and adding more to those longer-term bonds because rates have moved up quite a bit, and we're starting to get signals that are actually positive on bonds, surprisingly enough, right? So fortunately, we were able to sidestep some of that yield rising earlier this year, but we're getting bond levels that we haven't seen in quite some time here. And if we think that there could be some economic weakness coming up, or the Fed isn't going to move as quickly as they think, these could actually be attractive levels. We haven't made a decision on that yet, but with something that we've been talking about, so I wanted to just communicate that. And that's kind of where you see we're like right there. And this isn't the end all in terms of indicators, but that is as close to a buy signal as I've seen this been in a while. So, and I wanted to leave it with this. This is a chart. It took me, I kind of put it out of place here because I wanted to get this gentleman, Charlie Belios. He puts out some good charts, and this was one of the best ones I've seen him put out. This looks at the worst 6-month period. So this is different than looking at the start of the year. This is just taking any 6-month period that you've had and ranking them of the worst that have ever occurred on the Wilshire 5000, which is like the entire US stock market, more or less. And then it takes a look at 3 months, 6 months, 1 year, 3 year, 5 year, and 10-year total returns here. This is for the people that are kind of saying, oh, I'm out, right? It's down too much, or the next time we drop 10% from here, which could obviously happen. Like, you can see that the track record, maybe 1 year out, there was one negative return in the 2000 timeframe, but pretty decent returns over a period of time. Some not as good as others, and some maybe not as good as putting your money in long-term bonds. But the mean return on all the worst periods is 281%. And that is pretty amazing in terms of like the average return that you could get. Once again, trying to find the bottom is extremely difficult, but I think sometimes it's just staying in the game that really kind of makes up the difference between a bad mistake and getting a long, good outcome. So as I mentioned before, I would say stocks in the portfolio, it really depends on the portfolio. For clients that are not taking cash out or not investing cash, we're actually underweight equities. for people that are taking cash out, we need to raise money and we kind of rebalance it. Those are market weight stocks or slightly underweight. We're currently underweight bonds and overweight cash. And I said, that's up for debate currently. Not every account is the same, but we've been kind of holding that, 10% or so in cash plus, maybe it's even actually up to 12% now. We're pretty much market weight across the board on our holdings that we do have in equities, slightly overweight international in some of the retirement accounts where there's no taxes to be held there. We've been a little more tactical. One change that occurred since our last update is we did close out a higher credit, a lower credit quality position in the portfolio because traditional bonds were actually down more than the more aggressive bonds for the year. This is a good way for us to take a little bit of risk off the table. And then as things begin to rebound or when they do, to maybe look at things that we could be a little bit more specific with rather than a fund that's being kind of managed broadly. We're still what we call underweight duration, holding some shorter term bonds. Like I said, that is currently up for debate. And we're holding gold in the portfolios as well as a hedge. That worked out extremely well until the recent bump up in the dollar. Still outperforming, for the year, it's still up more than stocks or bonds are. But nonetheless, that's also, we continue to look at that on a very regular basis on our investment committee to seeing if it's something we still want to hold or if we want to take advantage of the declines in the other asset classes. So the bottom line, like I said, worst start to the year since 32, driven by global inflation concerns and central bank tightening. The inflation signals are kind of mixed, like I talked about before. So they're going to be elevated. The question is that inflation expectation, is that going to moderate enough? And that's really happened, like I said, more from the tough talk than from the actual interest rate increases. And so that's really the interest rate expectations have dropped dramatically in recent weeks. And I think that's one of the reasons the market's kind of rebounded here a bit. So as I mentioned, a recession is always possible, but the US economy is still showing growth with solid employment. And the worst could be over if no recession materializes this year or early next year. So unfortunately, we don't know the answer to that question. So right now we're just neutral to slightly underweight equities with excess cash, and we're waiting for that opportunity to deploy. And we're going to be, when that occurs, we will be ready to do so. In the meantime, we'll just patiently wait and make small adjustments as needed from here. So with that, Tyler, I will open it up to any questions that anybody has on anything, or if you got some that came in while I was giving the presentation, that'd be